I'm Brian Briscoe, host of the Diary of an Apartment Investor podcast. And this podcast is different than everything else out there. I bring together a new and an experienced investor on each episode, and I let the aspiring investor ask the questions that they need answered. So if you're an aspiring investor yourself, you probably will have the exact same questions. Now, before we get to this episode, make sure you hit the subscribe button below and that little bell to make sure you get notified every time we post a new episode. And now, enjoy the show.
So as you're underwriting and analyzing deals, what processes do you have in place to vet your own assumptions or challenge your own process and validate that?
Our setup is very good because I no longer am the one who's actually underwriting, right? I have an analyst who's underwriting, and then that is coming to me. So I'm kind of able to bring my fresh eyes to it. Whereas if I were staring at the spreadsheet all day, I would kind of get... It's like when you write a paper and then you can't see the comma mistake and the spelling mistake because you're just reading right over it, right? There's a couple key assumptions that we have to be able to defend. And number one are the pro forma rents, right? We have to have a business plan outlined to justify the pro forma rents. And then we have to have rent comps to support those pro forma rents. Expenses are pretty easy. Expenses are just based on our management experience and our portfolio. So that's not very tough. Then the other thing that is kind of a hot topic is the exit cap rate.
Welcome to the Diary of an Apartment Investor podcast. I'm your host, Brian Briscoe with Four Oaks Capital. Very excited for today's show. It's one of our Ask the Expert episodes where we have an experienced investor and an aspiring investor together. We got two great people on the line with us. We got Robert Beardsley and Vessi Kapoulian. So as is our tradition, Rob, you're up first. So welcome to the show.
Thanks for having me.
Yeah, appreciate it. And it was good seeing you at Best Ever, week and a half ago, and glad we're finally able to talk.
Yeah, absolutely. Looking forward to it.
Do us a favor and tell us a little bit about yourself. Give us an idea of your background, where you're coming from, and how you got into multifamily real estate.
Sure. So like you said, my name is Rob Beardsley. I'm the founder of Lone Star Capital. My business partner and I, Kent Petrakovsky, we started our company Lone Star about 4 years ago to focus on owning and operating Texas multifamily. And to date, we've acquired about 300 million in assets. Again, all focused in Texas with a primary portfolio in Houston. We've also built out our own in-house management company based in Houston to really drive operations.
Okay, interesting. Now, that's something that a lot of people do, but I think something that's unique is, and you posted this on LinkedIn a couple week or two ago, is you just turned 25. So starting a company at 21, tell us a little bit about that. And was it scary? I mean, what possessed you as a 21-year-old to start a multifamily investment company?
Yeah, so it certainly was scary. There's a lot there, but I think starting a company at any age is scary. The story goes, my business partner and I, we met through Joe Fairless's mentorship program. So we actually met for the first time at Best Ever. So it's amazing to come full circle 4 years later and to be on stage at Best Ever as we were there just a couple of weeks ago. So prior to forming our company and meeting, my business partner was a tax attorney at MetLife. He's born and raised in Brooklyn. So he's been in New York his whole life. I grew up in California. While I grew up in a real estate family, my parents ran a residential brokerage firm. I really didn't have much interest in real estate. I was more focused on tech. Growing up in Silicon Valley, I thought I would do a startup maybe. So I always had an entrepreneurial spirit, but thought I would be focusing on something else. Yep. But while in school, studying computer science, I was just doing my own research and was intellectually curious and found multifamily, the podcast, the Bigger Pockets, the meetups, and that just really started to consume me. So I fed that itch by joining Joe's mentorship group. And then that led to just meeting really good people. So just the network and the relationships really allowed me to have the confidence to push forward and take these risks and seize the opportunity.
Awesome. Yeah. And you've done amazing things since, so I've definitely been following you a little bit. And I think I first heard your name attached to an analysis spreadsheet that you created. And I know a lot of people that used have used that and have downloaded that. And hearing your background in computer science, it kind of makes that sound a little, a little more reasonable as why that came into pass. But tell us a little bit about why you created that underwriting tool and how other people can use it.
Yeah, it's really kind of a funny story, because when I started learning the various aspects of the business, I naturally gravitated towards underwriting. I liked making sense of the numbers. And in my mind, if I could understand the numbers and be comfortable with numbers, then I could be comfortable investing. Yeah. And I think that's the same for a lot of people. So, but some people don't think in numbers, but I certainly do. So in my mind, I thought, well, this should be pretty straightforward. I'll just download a model online and I'll use that. But I started downloading a few, using them, and they were fine. But my dad said, no, this is not what you're going to do. What you're going to do is build your own. And I thought that was a waste of time. Why would I recreate the wheel? Right. But he kind of put me on that project, and I started going through the process of analyzing a bunch of different models, picking the best things that I liked, and then starting to build one from the ground up. And at this point, I've built, thrown away, rebuilt my model so many times to just getting it tweaked to just where we like it. And we're still making tweaks today. So that is something that, really started from the beginning. And then I had the idea to give it away, because I thought, the funny thing is a lot of people actually sell their model. But in my mind, I thought, well, if I have a potential investor who wants to see my model, am I going to have to sell it to them? Right? Am I going to keep it confidential because, well, no, this is behind a paywall. So to me, I felt, well, why don't I just give it away for free, which will help people learn and understand the numbers better, which will make them more comfortable investing. So that was the angle we took. And that's really helped us, as you mentioned, kind of grow our network and get our name out there.
Yeah. It does solve a problem. I grew up using a proprietary one of those things, so, when you sign a little non-disclosure agreement saying you're not going to share it with other people. And we have had that issue a couple of times where people want to look on our underwriting a little deeper, and you're just like, okay, now you're in that quandary, do I share it and potentially give out proprietary information that I shouldn't, or, send them screenshots or whatever. I think that's actually a really smart move in a lot of ways, and definitely puts you on the map. Now, you also wrote a book on underwriting too, right? Was that same time, or how did that come along?
So that was a bit later. I had the idea from the start, because from the start, when I started learning to underwrite, I figured there would be a straightforward kind of how-to guide out there to do it, but there really isn't. Maybe you can sign up for a $2,000 weekend class to learn, or I don't know. I just had a hard time finding something that was really helpful. So once I went down that path, I told myself, all right, well, when I finally learn this, I'm going to go back and write a book on it, because it really would fill a void in the market. And that didn't happen until some years after actually building the model. And then on top of it, sure, we give this great model away, but it's pretty straightforward, but it's not that straightforward to use, right? So but accompanying the model with the book really empowers someone to learn a ton about analyzing property, understanding valuation and structures, and then also actually use the model.
Yeah. I will say that if you understand underwriting, the model is fairly straightforward. And the part of your model that isn't straightforward, I think is for people brand new to the multifamily space. But I mean, the first time I opened it and started looking at it, it was, to me, straightforward, but I've used several different tools, previous to, and kind of, I do like it. It's intuitive. It's a little more powerful than some. And, best of all, for lots of people, it's free. So, anyway, good on you for that one. And, your book has been super popular. A lot of people that I've talked to in, both on this podcast and in our Tribe of Titans network, use your tool and, swear by your book. So, amazing things you've done. And man, I wish at 25, I had done half the things, or even a tenth of the things that you've done so far. So, that said, what drives you? And it's kind of what I call your big burning why. So what's your motivation, your big burning why?
So growing up, I was always two things. I was always participating in team activities, team sports, and was a leader. So I was a math tutor, I was a piano teacher, a quarterback coach. I was, captain of the football team. So I always liked to kind of teach and kind of bring people together. And I'm comfortable to be the one that takes on the success when you win, and then share that around, and then also take on the blame when we fail and keep it to myself.
Yeah.
So that's kind of my personality and what I think my strengths are. So my why is kind of a bit of teaching, a bit of team building, and growing something bigger than myself. Obviously, what we do isn't just real estate. It's really about people. And it's whether we're talking about our employees, our investors, our lenders, the brokers that we work with. So there's so many people that we work with. And one of our core philosophies is being a first-class partner. We strive to be first-class partners to our employees, everyone who I just mentioned. And in return, we want that back, because kind of in my why is, hey, I don't want to just make a ton of money and then live on an island. That's really boring. I do want to make a ton of money, but I want to do it with people who I care about and that don't drive me crazy. Yeah. So that's what we're looking for from kind of the business.
I love it. I love it. And it sounds like you're doing what you've always enjoyed doing, trying to excel and help people do the exact same thing as you've done. And I've got to say that you kind of break the stereotypical quarterback. You mentioned math tutor, piano tutor. I don't know very many. Well, first of all, I don't know very many quarterbacks, but it doesn't seem like the quarterback stereotype to me. But you got a very wide set of talents, and that's it's pretty amazing. But on your first deal, you were a pretty young guy. I mean, you said you started Lone Star Capital when you were 21-ish, if I remember. How many people asked you about your age? And how did you answer that question?
It's funny because the answer is way less than I thought, right? Because it was really important to me. And I figured that everyone would think it's really important too. Yep. But I was able to kind of get away with it a little bit. So in my own head, I was very concerned about it, right? And I was actively trying to find ways to hide my age and to lean on my business partner who's older, or kind of lean on my parents' experience and say, well, they did real estate, and which, it's all true and it's all good. But it's only recently that I felt more comfortable with my age and where we are at now. Yeah. So yeah, I think it was always something that I was aware of, and now I kind of am okay with it.
Yeah. Okay. I mean, I knew you were younger than me. I'm 40 something. I thought you were, late 20s, early 30s until that LinkedIn post, a couple of weeks ago. So it surprised me a little bit how young you were. And, once again, I've said this many times, like I said, I wish I had done, a tenth of what you've done by that age. But so let's talk about some of the deals or projects you've done. I mean, you say you've done a lot in the Houston area, and hence the name of the company, Lone Star Capital. Let's talk about, some of the deals, either give us kind of a rough overview of your philosophy, or, pick your favorite property and let's talk about it.
Sure. So, I mean, really quick, our philosophy, we're a pretty typical value add buyer with maybe the slight caveat that we're looking for, kind of an often used term, but risk adjusted returns across the risk spectrum. So we've done deals that I would consider very low risk. We've also done deals that I would consider very high risk, or what you could say is traditional risk evaluation, as far as occupancy being low and crime and things like that, where, maybe there's ways you can mitigate the risk, but on paper, there's a big risk and you're chasing a big reward, right? And so we don't necessarily think risk is bad, right? You need to take risk, but you want to be paid for it. Yeah. You never want to take risk and not be rewarded for it in higher projected returns. So that's kind of one of our philosophies, is that we'll buy a deal for lower returns if we feel that the risk is really minimal and we're getting a great return there for that low risk. And then conversely, we've bought deals that are half vacant, crime, down units, right? And we've done that because we felt that the upside justified that risk. Yeah. So with that being said, one of my favorite deals is kind of somewhere in between on that spectrum. And we're actually under contract to sell it now. And it's going to be an awesome win for us and our investors. It'll be, investors will make over 30% returns.
Nice numbers.
And so we bought the property about almost 3 years ago. And it's a really interesting situation because it wasn't really your traditional value add. The property was already renovated. The units were in good shape. but the occupancy was 80%. So it was kind of unclear why the property was underperforming, and it steered away a lot of buyers. A lot of buyers were thinking, well, there must be something wrong with this property and it's overpriced. And we kind of sat there and waited it out, and we saw that nobody was buying the property. So we kind of kept involved, and then we finally got our bid accepted at our slightly lower price. And that was when it was time for us to go to work. And just basically through marketing and very limited capital expenditures, we were able to lease the property actually from 80 all the way up to 100. And then we kept it up 95% plus through our period, as well as pushing rents, and really got the benefit, of course, of the market being amazing and being in the right place at the right time. So that, I think, is a good example of us being nimble with, hey, we don't just have a simple box of we just do renovations and that's all we do, right? We're looking for value however we can find it.
Yeah. Now, a follow-on question to that, because a lot of people kind of pick the same templates, and when you're going back to the same investor pool, I think there's a lot of value to not changing the template, and you have a wide range of different risk-adjusted or risks and reward type scenarios. How do you fund that? I mean, do you guys have a fund developed where you're adding different things in there to keep an overall risk profile, or are you raising money deal by deal?
Everything we've done has been deal by deal, which I think is how most people start. And of course, we started with friends and family. And what we quickly realized after our first couple of deals is that if you find a good deal and then the money will come, we discovered that to be a complete myth, because we found good deals and there was no money.
Yep.
And that was our fault, because we didn't dig the well before we were thirsty. We just assumed that, hey, if we find a good deal, they'll be investors, but really it doesn't work like that. You have to put in the effort. And so after those really tough experiences, we finally gave investor relations the proper respect and effort that it deserved. And so that really helped us grow a lot. But to answer your question, today we raise money on a deal by deal basis. We work with high net worth investors, family offices, private equity firms. So we have a really diverse range of investors that invest anywhere from 100,000 to 10 million.
Nice. Now, is one type of risk versus reward profile easier to raise than others? I mean, what's your experience been with that?
It depends, because high net worth investors who aren't necessarily professional investors, that all types of investors have their pros and cons. But if you talk about your typical high net worth investor, they are really comforted by cash flow. So whenever you're trying to do a deal where there's lower cash flow or maybe even no cash flow in the first year, that's a super tough sell. So it's really simple. The better the cash flow, usually the easier it is for investors to get it and want to invest.
Yeah, I think that's a good metric to look at, and something that I look at on my passive investments. If it's cash flowing day one, it's a lot lower risk, and I think the operators are much more likely to hit the returns if they have that runway. They're not going to run out of money anytime soon if it's cash flowing. So makes a lot of sense. Well, cool. Well, one question to ask, and then we'll start talking with Vessi. But what's next for you?
For us, like I mentioned, last year we brought property management in-house. This year we're going to be bringing construction in-house. So we'll be building a dedicated team / business to just focus on the portfolio's construction.
Nice.
Similarly, on the management side, we don't do any third-party business. So the management company that we built is solely dedicated to serve our portfolio. And for us, we just want to rinse and repeat the success that we've had in Houston particularly, and then start building out the same another portfolio in Dallas. So that's really the goals for the next year or two.
Awesome. And how many total units do you have again? Remind me on that.
I think we're at about 2,600.
Okay. And I'm going to go back on what I just said, where I said Vessi's up next. I got a follow-on question to the management, the construction management. Where do you think the line in the sand is between where bringing management in-house makes sense as far as unit count and whatnot?
Yeah, a lot of people think that it makes sense at 1,000 units. A lot of people think it makes sense at 10,000 units. I think it is. I mean, so by the math, right? If you want to break even by the math, it's somewhere around 800 units.
Okay.
depending on the market, right? If those units are in New York and you've got $4,000 rents, obviously you could do that at 50 units maybe.
Yeah.
But with us having average rents of about 1,000, 800 units is where we felt the break even.
Okay.
And so, but obviously you could do it earlier and then float the management company. Your management company doesn't have to break even. So I think it's more so based on your strategy and your goals. I would say that we vertically integrated earlier than most. When we vertically integrated, we were right at about 1,000. So I think that's fairly early, but we felt it was good to do that and lay the foundation and grow with it rather than do it later and have potentially more people, more systems, more properties to break down.
Okay. And I'm going to ask the same question for the construction management. I mean, if you're doing all value add, why wait to 2,600 units to do that? Why not do that along with the property management?
Yeah, I agree. I mean, the construction management side, honestly, so far fewer people bring construction in-house than management in-house. Management in-house is already kind of rare, but what's funny about that is construction management is a lot more profitable. So you can start breaking even on construction management at 3 million per year in construction. Yeah. So I think we're going to have somewhere around maybe 20 million in construction in the next year or so. Yeah. So it just makes way too much sense. But the reason why we didn't do it all at the same time is just because, one step at a time, not take on too much at once.
Yeah, makes a lot of sense. Yeah. And I mean, looking at our portfolio, we definitely did 3 million in renovations last year, trying to get to that $20 million mark. And, I think in a lot of ways it would have helped to have the construction management in-house instead of, having to, in our case, work through the property managers and vendors and whatnot. But anyway, thanks a ton for all of that. We're going to shift gears right now and now bring Vessi on. So Vessi, welcome.
Thank you, Brian. It's a pleasure to be here. And I felt very lucky today because when I first started underwriting, I actually read Robert's book. So it's an honor to be able to talk to you, Robert, as well.
Awesome. That's really cool. So Vessi, tell us a little bit about yourself.
So I currently reside in Los Angeles, California, but I'm originally from Bulgaria. Came to the US with the initial intent to go to school and then go back, but needless to say, that did not happen. Growing back in Bulgaria, there wasn't really a developed stock market. So when it comes to investing, real estate and hard assets was the approach a lot of people followed. So one could say the real estate seed was planted in me early on. But I followed the traditional path of going to school, getting good grades, getting into the corporate job, and didn't really take the first action, if you will, until I bought my first home in 2005. And that was a great investment from the perspective that it helped partially pay for graduate school versus having that cash sit in a bank, and really made things real as to why investing in real estate made sense. And subsequently made the first out-of-state investments in residential properties. That was going quite well. And naturally, the question in my mind was, well, how do I scale that? How do I make this larger? And that led to multifamily, which is the path I'm currently pursuing.
Awesome. Amazing. And you said your first investment was 2005. How did that weather the 2008 recession?
So I actually sold in 2007, and I remember right at the top. Of course, I won't take any credit, right, for timing the market. It was just how I had planned to, or when I had planned to liquidate the investment. But one thing I remember is, as the seller and I were going through the negotiation, I remember the thought in my mind, don't get greedy. And I'm certainly glad I didn't, certainly glad that we closed on the deal, because just a couple months later, the market crashed. So had we gone into a prolonged negotiation, I probably would have been on the wrong side of the table.
Yeah. Well, I amazing that you picked that time to sell. I picked 2007 to buy my first property. So, and fortunately, like Rob said, I cash flowed. I actually bought a property that cash flowed. And then we went under as far as value by quite a bit, but the rent paid the mortgage every single month, and I never had to worry about it. So I was fortunate on that one as well. And anyway, well, cool. Thanks for sharing that. So I mean, you talked a little bit about reasoning for getting in, but if you could focus on your motivation, your big burning why, I'd very much appreciate it. What's your burning why?
Absolutely. I would say for me, that's the freedom of owning my own time, and which ultimately will give me the opportunity to live a life of significance. And to me, that means being able to spend time with my loved ones. And one day when I start a family of my own, being able to take my kids to school, ability to have flexible time to be involved with the community, and so much more. And real estate is really a tool or a means of getting there. But that's what continues to drive me every single day.
Awesome. I very much appreciate it. Well, here we come to my favorite part of every episode. Vessi, we got Rob on the line. What do you want to ask him?
Well, I have a ton of questions, but I will start with one of my favorite topics, and that's underwriting. We're obviously in a very interesting part of the market cycle, with competitive pressures heating up, cap rates at historical lows, interest rate at historical lows, and so much more. So in the current market environment, how, if at all, have you adjusted your underwriting criteria as you evaluate deals?
Sure. So as far as the way that things have changed with underwriting, one of the overarching things that we're experiencing is inflation. So that permeates the revenue side, the expense side, as well as what's also happening is the projection of future rates. So most of our loans that we do are floating rate loans. So we have to incorporate the forward curve, which is the future path of rates projected by the market, into our model. And right now, the market's kind of all over the place. There's really a ton of uncertainty as far as where rates are headed. And when there's uncertainty, things are usually like when volatility is high, pricing is elevated. So right now, people are erring on the side of caution and projecting higher rates. I personally don't think we'll end up seeing such higher rates, but that's another conversation. But right now we're immediately experiencing that pain, and our cash flow is lower because we have to project those higher rates. So you're seeing it right away, and as far as projected cash flow in our underwriting. So for us, it's not necessarily changing the way we underwrite, but it's making us more concerned, more focused on that, and also more accepting of that fact and saying, well, hey, this is the reality. And so we're readjusting a bit to what a good deal to us means.
I like that. So when you follow on question, when you talk about good deal, are you lowering your projections as far as what your IRR is to the investors, or what does that mean to you?
Yeah, generally, I think the IRR is pretty much staying the same. The cash flow is what we're okay with going down a little bit on. And cash flow obviously varies a lot between deals, whether you're buying it with a agency loan or a bridge loan. So some deals are optimized for cash flow to begin with, and some deals cash flow really isn't a focus. I would say for us, so we were lucky enough to buy 2 deals last year with agency debt, and that's getting really rare, tough to find in place cap rates high enough to support that. On those deals, we're able to do 8% cash on cash in the first month. But these days, most deals, because we're pursuing value add deals, because we're buying at lower cap rates, it's more so 5% year one. And then maybe we're getting to 8 in a couple years, and then averaging out to 6 to 7. So it's just a more compressed environment.
Okay. Interesting. All right, Vessi, back to you.
Absolutely. And I've definitely seen that. And actually, follow-on question, how easy, or have you seen investor expectations adjust given that current environment? I still see a lot of deals with being advertised right at 8 to 10% cash on cash, but completely agree with you. It's becoming harder and harder to achieve that. So curious on your view as far as investor expectations.
Good question.
Yeah, that's a great point. It is tough because there are plenty of investors out there that still think that, well, they basically have gotten spoiled by past returns. and they think, well, hey, 20, 25% is the norm. I want that or I'm out. And that's tough. What can you do? I could tell you what we could do. We could present those numbers to them that way, and then they'd probably invest, but then we're setting them up for disappointment later. So as cliche as it is, and as really hard as it is, we would love to under promise and over deliver, but we have to balance that with the very plain fact that if we don't project strong enough returns, we won't get investors excited. So it's that very delicate balance of how do we be aggressive enough to get investors excited, but be conservative enough to feel comfortable with the investment.
Mm-hmm. Yeah, I think that's a balancing act that a lot of people are trying to play right now, and just find that happy medium where they're still confident in the numbers, but can attract investors. So good solid answer.
Thank you. And I often like to say that underwriting is very much a mix of an art and a science. There's definitely a methodology to it, but a lot of it comes to also developing your own judgment. So as you're underwriting and analyzing deals, what processes do you have in place to vet your own assumptions or challenge your own process and validate that?
Yeah. So I think from that question and angle, our setup is very good because I no longer am the one who's actually underwriting, right? I have an analyst who's underwriting, and then that is coming to me. So I'm kind of able to bring my fresh eyes to it. Whereas if I were staring at the spreadsheet all day, I would kind of get, it's like when you write a paper and then you can't see the comma mistake and the spelling mistake because you're just reading right over it, right? So it's here I'm able to look at the underwriting with fresh eyes and make quick, good decisions. So, but as far as defending our assumptions, there's a couple key assumptions that we have to be able to defend. And number one are the pro forma rents, right? We have to have a business plan outlined to justify the pro forma rents. And then we have to have rent comps to support those pro forma rents. It comes from both angles, right? What are you going to do? And then how, does it already exist in the market? And so that's pretty straightforward. Rent comps are straightforward, but they're time consuming. You have to look at the data, call the properties, ask for specific questions about the features, interiors, other income. So that would be the first angle. Then expenses are pretty easy. Expenses are just based on our management experience in our portfolio. So that's not very tough. Then the other thing that is kind of a hot topic is the exit cap rate. The exit cap rate is a very big lever and makes a big influence on your projected returns because that's what determines your sales price. And for us, we feel very confident in our exit cap rates because of our localized knowledge in the market. We underwrite, in very specific locations or, in certain markets. So we know the market well. And then we track all that data. Every single deal we underwrite, we track that data. And every quarter we analyze the data so we can see, okay, what was the average cap rate that we underwrote in the market? What was the average price per unit, the average CapEx that we projected? So we really have an amazing amount of pipeline or deal flow data, which can help inform our exit cap rate. Because if we know that for this type of deal, the cap rate today is 4, then we feel more confident projecting an exit cap rate of, let's say, 5.
Absolutely. I find that and there's a lot of debate as well around, well, where are interest rates going to be? Do cap rates follow interest rates? So certainly can appreciate that. Usually there's a lot of thought and discussion that goes around that topic also.
Definitely.
Now, one follow-up question. I mean, you have 26 units in the greater Houston area. Are you using those for a lot of your comps, or are they clustered close enough where you can use those as comps? And how can you leverage, your large portfolio in one city or one metro?
Yeah, we're under contract on a deal right now where we own right down the street. So that makes things much easier for various parts of the analysis. And we're selling that property, so that's not going to be a synergistic integration into our portfolio necessarily, but that can happen. Right now, we're looking at bidding on a property that's just a 10-minute drive from one of our other assets, which is not right next door, but 10-minute drive is certainly within reasonable distance to where we can get some payroll synergies where if it calls for it, instead of having a full-time maintenance person on both, maybe we can have a floating, so that way we're saving on half of a full-time salary. So there's some things like that we can take advantage of.
Interesting. All right, Vessi, once again, back to you.
Great, thank you, Brian. And Robert, I know people often refer to multifamily as a team sport, and even as you were sharing your journey, you mentioned we, my partner, and I. So the next question I have pertains to selecting and vetting partners, and how do you do that while at the same time balancing the speed of execution? Oftentimes, people say you need to date the person you're partnering with, but in the current environment, which is quite competitive, if you don't act fast on a deal, you may not have the opportunity to own that property. It seems like it's a fine line between the two. So curious what process you went through as you were selecting and vetting your partner team.
Yeah, so there's two sides here. One is the partnering of Lone Star, right? Me and Kent. And that was a very lucky experience because we met at the conference, and that's probably not something that you should do, is just meet for the first time at a conference, get excited, and then go forward. So we just got extremely lucky. We've never had an argument. We just work super well together. It's just great. So we got really lucky. But with that being said, even though it was a foolish thing to do, we still dated a little bit. We pretty much from then on, we were on the phone every day, looking at deals together. We didn't really say, hey, let's start up right away, but we just kind of said, well, let's look at deals together. Let's see how each other think. So that process took maybe about 3 months. So I think that's kind of the bare minimum. And I just got, again, extremely lucky. And then the other type of partner is kind of the people that our company works with, right? Whether it be investors or partners that work with us raising capital or investing. So those types of relationships, I think, are best built through actual deal flow. So even if it's kind of too early for us and a partner to work together, it just still makes sense for us to share a deal with them, and then they share their thoughts, and we kind of go back and forth, see how they think. They get a sense of, okay, are these guys professional? Do they answer questions well? Are they communicative? And there's certain signs that you can see of just kind of, again, going through that dating of looking at a deal together to hopefully know if it makes sense for the future.
Yeah. And my group came together pretty quickly as well, and it was lucky, it was fortuitous, and we worked together fairly well. But I think you go in eyes wide open, and always be questioning that as well. How can we get better, and how can we keep improving? And part of the eyes wide open is also look for signs. Are there any signs that of trouble ahead, and see what's going on? But it's hard to do. I think people have to, in most cases, have to partner up before finding their first deal. And sometimes it is a very hasty arrangement, hasty partnership. But even if you get into a bad partnership, I mean, just one quick remedy is just not to do it again, not to partner with that person again in the future. Do what you have to do to make sure that deal works. But that's part of the dating. I guess that's the going steady portion. But anyway, we are about out of time. So just want to thank both of you for coming on again. And one final question for each of you: how can our listeners learn more about you? And Rob, you go first. Sorry.
Yeah, sure. So if you want to learn more about myself and Lone Star Capital, you can head over to our brand new website, which is lscre.com. So that just stands for Lone Star Capital Real Estate. So lscre.com. On our website, there's links to our free underwriting model download, my underwriting book available on Amazon. So there's a lot of resources to find on the website.
All right. Awesome. And Vessi, same question for you. How can listeners learn more about you?
The easiest way to connect with me would be through LinkedIn, or people could also email me directly at Vessi, VESSI, at thevesik.com.
All right. Sounds good. And we'll put links to the show in the show notes to the website, LinkedIn profile, and email address. And so anybody interested can just tap, swipe, and tap if you're on your phone and get that information. So, once again, thanks so much to both of you for coming on the show. Very much appreciate your time today.
Yep. Thank you so much.
Hey, if you like that episode, make sure you hit that subscribe button. But more importantly, if you haven't joined our multifamily educational community, the Tribe of Titans, yet, you are missing out. So get yourself 30 days free by clicking the link below in the description, or go to thetribeoftitans.info, and we'll see you there.